Hey everyone, and welcome. We're diving into a really cool idea today. The notion that your investment strategy shouldn't just be a static set it and forget it plan. Think of it like a video game. As you level up your income, your financial strategy has to level up right along with it. So let me just ask you that straight up. Do you think the way you invest should fundamentally change as you start earning more? I mean, a lot of us just keep doing the exact same thing, just with bigger numbers, right? Well, the source material we're digging into for this explainer says, nope, it's not a choice at all. They argue that adapting your strategy isn't just a good idea, it's an absolute necessity. If you stick with a beginner strategy when you're earning a high income, you are basically leaving a massive pile of money on the table. Okay, let's get into it. Here's our roadmap for today. We're going to climb this 5-level investment ladder. We'll start at the very beginning, the foundation, and go all the way up to the end game for the highest earners. And you'll see, each level has its own unique playbook. But hang on, before we even take that first step, there is one non-negotiable rule that our source insists on, and it applies to absolutely everyone, no matter what you earn. You have to have health insurance. Seriously, one medical emergency can completely wipe you out and throw your entire financial journey off the rails before it even gets started. All right, with that out of the way, let's jump into level 1, the foundation. This is for folks who are just starting out in their careers, earning somewhere in the range of, say, 20,000 to 50,000 rupees a month. Now, at this stage, the source is crystal clear. Your number one job is not to become the next stock market wizard. It's to increase your salary. The absolute best investment you can make is in yourself. Upskilling, courses, books, whatever it takes. I mean, think about it. Turning a 5 lakh portfolio into 10 lakh is great, but it won't fundamentally change your life. Doubling your salary, though, that is a total game changer. So focus on you and just park any extra cash in simple, low-effort index funds. Okay, you've leveled up. Welcome to level 2, the practice ground. Your income's growing. Maybe it's somewhere between 50,000 and 1 lakh a month now. You've got more disposable cash, and it's time to start getting a little more serious about this whole investing thing. So what's the first move? According to the source, it's a super simple but incredibly powerful one. Always, always choose direct mutual funds over regular ones. Why? Because regular funds have these hidden commissions that are just brutal. They eat into your returns every single year. Just how much do these little fees actually matter in the long run? Let's just put a number on the screen. -33%. What on earth could that mean? That right there, that is the total chunk of your potential wealth that just gets vaporized by a seemingly tiny 1% annual fee over 40 years. You could lose a third of your entire portfolio just to fees. It's just madness when you think about it. So, at this level, the game plan changes a bit. The source suggests you keep about 80% in those low-cost direct funds. But now, you take the other 20% and you start buying individual stocks yourself. Now, the goal here isn't to get rich quick. It's to get your practice reps in. You're learning how to value a company, you're learning the emotional side of when to buy and sell. This is the training ground for when the stakes get much, much higher. And that brings us to the strategy zone. At an income of 1 to 5 lakh rupees a month, we're not playing with practice money anymore. You're now investing serious cash, maybe 6 or 7 lakhs a year. The game has totally changed, and you need to unlock some new skills to play it well. To really crush it in the strategy zone, the source says there are 3 new skills you have to unlock. First, you've got to master valuation, so you actually know what a company is worth before you buy its stock. Second, you need to learn about capital rotation. That's the art of knowing when to move your money around. And third, it's time to get really serious about optimizing your taxes, so you can keep more of what you make. Let's just zoom in on that first skill, valuation. One of the fundamental tools in your kit is the PE ratio. And all it really does is compare a company's stock price to how much money it's making. A really high PE can be a huge red flag that a stock is just way too expensive, even if you love the company. And this is a perfect real-world example. The source uses Zomato as a case study. At the time of this analysis, its PE ratio was around 1,500. I mean, that's just astronomically high. You might say, yeah, but it's a growth company. Okay. Fair enough, but even if Zomato's earnings grew by 10 times, its PE would still be a very, very high 147. This is the kind of critical thinking you need to do to avoid falling into these valuation traps. And now we've made it to the final level, level 5, the end game. This is for people earning 10 lakh rupees or more per month. And up here, the priorities, they shift dramatically. It becomes less about crazy growth and more about preserving your wealth, being incredibly tax efficient, and avoiding products that are designed to destroy your value. So what should you be avoiding? Well, our source does not pull any punches here. They call many of the portfolio management services, or PMS, and alternative investment funds in India extremely stupid instruments. Wow, that's a pretty bold statement, so let's look at why they say that. And it really comes down to one thing: fees. Again, look, if a 1% fee costs you about a third of your portfolio, what do you think a 2% fee does? Well, over the long haul, it could potentially wipe out a mind-boggling 70% of your final portfolio value. The math is just absolutely brutal. That 2% annual fee that many of these services charge creates such a massive hurdle for them to overcome that over time they often struggle to even match a simple, low-cost index fund. You're basically paying a huge premium for the privilege of potential underperformance. It's wild. So, what is the playbook for the end game? Well, first off, you avoid those high-fee products like the plague, and you take control, actively managing at least half of your money yourself. Your focus shifts. You want to build a tax-optimized base. This is where you might explore more sophisticated things, like using options to generate extra income, calculating your returns in dollar terms to hedge against currency risk, and maybe even dipping your toes into some high-risk, high-reward venture capital. So we've climbed the whole ladder, from the foundation all the way to the end game. And that brings us to one final question for you to think about. I want you to take a hard, honest look at how you're investing your money right now. Is your strategy actually built for your current income, for who you are today? Or is it just a relic, a ghost of a past income level? The answer to that question could be the key to unlocking your next level of wealth.